Welcome back to Simple Finance Bytes, where we simplify personal finance so you can focus on what matters most, achieving true financial freedom through systems that actually work. I'm your host, Ernest, and if you're new here, think of this podcast as my letter to my 16-year-old self, sharing everything I wish someone had taught me about money when I was starting out. Today, we're talking about something that scares some people, investing. And here's the thing. The investment industry has made investing seem way more complicated than it needs to be. They want you to think you need a financial advisor, complex portfolios, and years of study before you can start building wealth. That's complete nonsense. And today, I'm going to prove it. We're covering Robinhood's setup for absolute beginners, why it's perfect for people just starting out, how to set up your account without getting overwhelmed, and most importantly, the psychology behind why simple beats complex every single time. Now, why Robinhood for beginners? Let me be clear about something first. I'm not sponsored by Robinhood, and this isn't financial advice. This is financial education about why Robinhood works so well for beginners from a psychology-first perspective. Traditional investment platforms were built for people who already understand investing. They're packed with features like charts and research tools and options that just overwhelm new investors. It's like trying to learn to drive a Formula One race car instead of a Honda Civic. Robinhood did something revolutionary. They made investing feel normal. No minimum balances, no commission fees, and an interface that doesn't require a finance degree to understand. It is dead simple. For someone taking their first steps into investing, this removes the biggest barrier, intimidation. Here's what I wish someone had told me when I was starting out. The perfect is the enemy of good. I'm sure some of you have heard that quote before. You don't need the best investment platform. You only need the one you'll actually use. And for most beginners, in my opinion, that's Robinhood. Now, that's not to say that all of the others are bad or that they're not good. There are plenty of excellent investing platforms out there, some of them just as simple as Robinhood, but Robinhood is the one that I found that just makes it easy for everyone. If you want some alternative recommendations, feel free to reach out and I'll give you some. But for the purpose of this podcast and for people who are just wanting to get started now in a way that's not intimidating, Robinhood is my recommendation. Now, there's an entire psychology around starting simple. Your brain is wired to avoid things that feel complicated or risky. It's just human nature. This is why so many people never start investing. They get paralyzed by all the choices and the complexity. On top of that, traditional investment platforms, they feed this paralysis. They have hundreds of options and research tools you don't need. Robinhood removes the friction. When investing feels as simple as using any other app on your phone, you're more likely to start. And starting is 90% of the battle. I've seen people spend months researching the perfect investment platform while their money sits in a traditional savings account, earning practically nothing. That's not smart. That's self-sabotage disguised as research. So you're going to need a couple of things before you start. Before we talk setup, let's make sure you're ready to invest. You need 3 things. First, you need your basic emergency fund in place. I'm talking about at least $1,000 in a separate high-yield savings account that you don't touch unless it's a real emergency. If you don't have this, stop here and go listen to episode 4 about high-yield savings accounts. And $1,000 is the minimum here. I would actually prefer you to have about 3 months of your core and critical expenses in your emergency fund before you start investing. Second, you need to have paid off any high interest debt. If you're carrying credit card debt at 18% interest, paying that off is guaranteed 18% return. No investment is going to beat that consistently. So you need to pay that off first. I know a lot of times people get excited and want to start investing and they're carrying credit card debt, $10,000, $20,000, $30,000 of debt at 18, 20, 25, 29% interest. Do not focus on investing when you have that kind of high interest debt hanging over your head. You need to get rid of that debt first, then start investing. Third, you need to understand that investing is for money you won't need for at least 5 years. And I think this is another area where people get tripped up. They put money into investments thinking they can do a quick turnaround and get rich quick kind of thing. And then it doesn't go the way they want. They need the money and they've now lost money. So this is not for a short-term focus. This isn't your vacation fund or your car down payment money. This is money you're putting away for your future self. If you don't have all three of these in place, you're not ready to invest yet. And that's okay. It's okay. Just get the foundations right first and then move on to investing. This podcast episode isn't going anywhere. You can always come back to it later and reference it when you are ready. Let's talk about the Robinhood setup process. I'm going to give you a very high level approach here. There's some stuff that changes from release to release. It's all minor, but just know that there may be some additional steps or information they ask you for, and there might be less depending on when you actually do this. So, assuming you're ready, let's walk through the setup process step by step. Number one is download the Robinhood app and start the account opening process. You're going to need your social security number, driver's license, and bank account information. This is standard for any investment account, right? So it doesn't matter that this is Robinhood. It's the same for Betterment. It's the same for Wealthfront. It's the same for Fidelity, Schwab, Vanguard. They all are going to require this information. They're required by law to verify your identity. And it's something called Know Your Customer, or you might have heard of it as KYC laws. That's what this is about. So don't be shocked when they ask for that information. They're required to ask for it by law. Here's where it gets important. When they ask about your investment experience and goals, be honest. If you're a beginner, say you're a beginner. Don't try to sound sophisticated. This affects how they present information to you in the app. So just be honest about it. If you're a beginner, say you're a beginner, and the experience becomes easier for you as you learn about this world of investing. For funding your account, start small. I don't care if you have $10,000 sitting around, start with $100 or $500. Why? Because you need to get comfortable with the process before you put serious money at risk. Connect your bank account for transfers. This usually takes 1 to 2 business days to verify, so just keep that in mind. During this time, use the app to get familiar with the interface. Look around, but don't feel pressure to understand everything immediately. Now, your first investment, the key here is to keep it simple, right? We're Simple Finance Bytes. We're always moving towards the simple answer because often the simple answer is the right answer and the best answer. This is where most beginners make their first mistake. They think they need to pick individual stocks. They see Apple or Tesla and think, I know these companies, I should buy their stock. Don't do this. Individual stocks are speculation, gambling, not investing. You're betting on one company's success instead of investing in the entire economy's growth. It's the equivalent of picking one horse to bet on at a horse race. What if you could bet on all of them and win no matter what in the end? That's what you're looking for here. So instead, you want to buy what's called an ETF or an exchange-traded fund. Think of it as buying a tiny piece of hundreds or thousands of companies all at one time. It's instant diversification without having to research individual companies. For absolute beginners, there's really only one ETF that I would recommend that you need to know about, and that's VTI. V as in Victor, T as in Tom, I as in Isabel. VTI, which stands for Vanguard Total Stock Market ETF or Vanguard Total Index. This single fund gives you ownership in essentially every publicly traded company in America. When you buy VTI, you own a piece of Apple, Microsoft, Amazon, Google, and about 4,000 other companies. If the American economy grows over time, which it has for over 100 years, your investment grows with it. The beauty of VTI is that it removes all the guesswork. You don't need to pick winning companies or time the market. You're betting on America's continued success, which is a pretty good bet historically. So remember, keep it simple, VTI. Now, adding some more psychology to this to make this work for you, here's a psychology trick that will make you successful. Set up automatic investing immediately. Don't wait until you, quote unquote, learn more or, quote unquote, have more money. Set up a small automatic transfer, even $25 per week, that goes from your bank account to Robinhood and automatically buys VTI. I have an automatic investment in my Robinhood account that's buying every day $10. And I set that up years ago and I've never messed with it. And so every single day it goes and buys $10 worth of an equity. That's what you want to do here. You don't have to do it $10 a day. That was just what I decided to do. And I've left it like that. But you could do $10 a week. You could do $25 a month. You pick what you're comfortable with and what you can afford. But the key here is that you automate it. You set it up to be automatic. Now, why does this work? Because it removes emotion from the equation. You're not trying to time the market or pick the perfect moment to invest. You're building a habit that runs on autopilot. Most people think they'll manually invest each month, but life gets in the way. You forget, you hesitate, you wait for a better time. Automatic investing bypasses all of this psychological nonsense. Start with whatever amount won't stress you out. Again, $5 a day, $5 a week, $5 a month. It doesn't matter. The goal isn't to get rich quick. It's to build a habit of consistent investing. You can always increase the amount later as your income grows and you get more comfortable with investing. Now, there are some common beginner mistakes to avoid. Let me save you from the mistakes I see beginners make all the time. First, don't try to time the market. You'll see the news talking about market crashes or rallies, and you'll think, should I wait or should I rush to invest? Ignore all of the noise. If you're doing that, you're doing it on emotion, and you should never, ever invest on emotion. With automatic investing, you buy during the good times and the bad times, and that just smooths out the volatility. What that means is over time, you're averaging out the price, whether it's up or down. That's what you want. Don't try to time it. Second, don't check on your account every day. I know it's tempting. I too want to check on my accounts every day. But you've got money in the market and you want to see how it's doing, right? That's kind of the temptation here. But here's the thing. Daily checking leads to emotional decisions. Check in monthly at most. Quarterly is even better. Even better than that is just looking in once a year. But yes, don't be checking on it every day because it leads to emotional decisions regarding money and you don't want to mix those two. Third, don't get fancy too quickly. You'll hear about options trading, cryptocurrency, and individual stock picks. Ignore all of that for now. Master the basics first. VTI and automatic investing will build more wealth than 99% of people trying to get clever with investments. I don't remember where I read the statistic, and it's now a few years old, but it was something like on a 10-year basis, something like 80% of professional money managers, these are people who have degrees and are making six figures a year and paid to know this stuff. Over 80% of them can't beat VTI or just the market in general, S&P 500, whatever you want to call it, the total market indexes. They cannot beat it 80% of the time. When you extend that to 20 and 30 years, you start getting smaller and smaller. And I think the further out you go, it basically goes to zero. In other words, none of those fund managers are going to beat the market. So keep that in mind. People who are professionals at this cannot beat the market over time. You're investing over time. That's how it all goes together. Fourth, don't panic when your account goes down. It will go down sometimes. That's normal. The stock market goes up and down constantly. But the long-term trend over decades is up. Focus on that long-term trend, not the daily fluctuations. That is so key here. The other thing to remember that I think is important for most people to just kind of wrap their mind around is, even if the market's down, even if your stock prices are down or your VTI is down, you haven't actually lost any money until you choose to sell that stock or that ETF. So you don't sell it when it's down. You wait until you need it years down the road, or if the market's up and you need it, that's when you sell it. And then you make a profit. So even if the account goes down, you're not actually losing money. That's just on paper. It's not until things sell. So don't panic when your account goes down. Just ignore it. Now, there are some times to consider some more advanced options. Once you've been automatically investing in VTI for at least 6 months, I recommend a year, but let's just, for those of you that get a little bit excited about this kind of stuff, wait at least 6 months. And then you're comfortable with the process. Then you can start learning about other options. So for example, maybe you want to add some international diversification with VXUS or some bond stability with VBIL. We will definitely talk about this stuff in future episodes of the podcast. So if you don't want to worry about it right now, you don't need to. But I know some of you listening are going to say, well, I want to talk about some additional options. Again, once you're comfortable, then you start looking at other things. But again, honestly, you could invest in nothing but VTI for your entire life and do better than most people with complex portfolios. Simple beats complex every single time in investing. The key is starting and then staying consistent. All you have to do is let time compound the growth for you. Let time do the heavy lifting. You don't do the heavy lifting. You just automate everything in small chunks and let time and the market do the work for you. The earlier you start, the more time you have for your money to grow exponentially. This is one of the big goals of this podcast and this entire channel, is to get this information to young people, 16, 18, 20, 25. Obviously, I'm speaking to all ages because this kind of advice is relevant to everyone. But if you're listening to this and you're young, or even if you're listening to this and you know someone young who could benefit from this, give them this information now. Because the earlier they start, the better it will be for them, the easier it will be for them. They can contribute smaller amounts over a longer period of time and be very successful. So the key is to start earlier. Let me wrap this up with what I wish I could tell my younger self. The best investment strategy is the one you'll actually stick with. Robinhood makes it easy to start. VTI gives you instant diversification, and automatic investing removes the emotional guesswork. If you're ready to set up your investment account but want some hand-holding through the process, I offer investment setup coaching where we walk through everything step by step. You can find details at simplefinancebytes.com. For those of you building your complete Simple Finance system, this is Module 4, Simple Investing that works with your psychology, not against it. The full system covers everything from banking optimization to debt elimination to building real wealth through investing. Again, information for that can be found on simplefinancebytes.com. Just look at the top of the page. There's a link there, I think, that says Simple Finance System or something like that. That's where all the information is fully documented. Next week, we're talking about credit cards, specifically the 2 to 3 card rule that maximizes rewards while minimizing complexity. You'll learn how to use credit cards as tools for building wealth instead of debt traps. If you found this episode helpful, the best way to support the show is to subscribe and leave a review. And don't forget to sign up for our free newsletter at simplefinancebytes.com for monthly tips that don't make it into the podcast. Again, the monthly newsletter does a recap of the prior month, as well as additional information that doesn't make it into the podcast episodes. I try to keep these episodes fairly short so that people can listen to them on their commutes, but a lot more information is on the website and in the newsletter. Remember, Simple Finance gives you your most valuable asset back, your time. Stop making money complicated and start building the financial freedom you deserve. Until next week, keep it simple.